We're going to get started with Ted Benensky from Insight Equity. Ted is the Chief Executive Officer and Managing Partner of Insight Equity Holdings. Insight Equity currently manages 3 buyout funds and a mezzanine fund and has $1.3 billion of assets under management. And with no further ado, I will let Ted go ahead and get started and bring us through a deal and why it worked. Thanks.
Okay. Thank you very much. So the deal I'd like to tell you a little bit about is Emerge Energy. It's a publicly traded company on the New York Stock Exchange. It trades under the symbol EMES. And I like to describe Emerge in a couple of different ways. Probably the first way is a Jed Clampett type story. And then the second way is just the combination of a lot of things going right on multiple dimensions that led to the success. Just for context, this is a company that really represents 3 individual portfolio companies of ours that were simultaneously put together and taken public, where the original equity value of the 3 deals was less than $100 million. And today's equity value, last time I checked on my stock reader, was $1.35 billion. So this is a major success story for us as a PE shop and for all of our investors. So when the deal was originated, it was primarily the sand company that has driven most of this value, so I'll focus there. And when we bought the company, it was less than $80 million worth of value. It was based in East Texas. And this represents what I would call the Jed Clampett story. It was a small, very unsophisticated family that was essentially mining sand and processing sand for the golf course business. So this literally was sand that was going into bunkers in surrounding local golf courses. And then one day, a couple of the large service providers started showing up and offering to pay 50% premiums on the sand. And they just kind of threw their hands up in the air. They didn't know exactly why this was the time to sell, but whatever was happening in the general marketplace, they didn't understand it, and so they were going to cash out as quickly as possible. So we went through a fairly limited auction process, which was representing the family. It was a middle market investment bank, locally based, didn't extend the materials to very many folks. So we bought the company at a very attractive multiple, approximately 5 times. And we proceeded to start to take advantage of what we started to analyze as the beginning of the North American shale revolution. This is back in 2008. And in 2008, you had a situation where the Barnett was actually a really powerful early play. And it was all based on dry gas prices, which were essentially at the $14 per MMBTU level. Well, in the next 6 months, those prices collapsed. They went from $14 to $2. And all drilling activity across North America essentially dried up. So you could argue that business that we bought for a little less than $80 million was worthless at this stage. And rather than close our doors and huddle in the corner and go focus on other portfolio companies, we decided to double and triple down on the investment. Why? This is another element of why this was successful. We knew that this market was about to explode. We studied it very carefully. We knew that there were a number of oil reserves and dry gas reserves and something called natural gas liquids that were prevalent across North America. And it would just be a matter of a fairly short period of time before people would be developing those reserves. So we doubled down and we made investments to secure reserves in what we determined to be the highest quality frac sand in North America, which is in Wisconsin and Minnesota and parts of Illinois. And we locked up what is today approximately 150 million tons of those types of reserves. We still had no cash flow. But we had the reserves, and we essentially began the process of investing to develop 2 state-of-the-art sand processing plants adjacent to those reserves and adjacent to rail, which allowed us to deliver the sand to the wellhead. Well, one thing led to another, and Even though we had 2 consecutive years of 0 EBITDA, in the third year, we escalated to 30 million of EBITDA. And then in the fourth year, we escalated to what was just shy of 70 million. And this year, we're actually going to hit probably about 100 million of EBITDA. So the deal has been extraordinarily successful, not from any kind of specific financial engineering perspective, but because a lot of underlying operating value was patiently discovered and harvested, which ended up driving the value of the company. Now, there was also a piece of financial engineering which was very important to the value. And that was, rather than sell this company on behalf of our investors and ourselves on a trade sale basis, we decided to combine it with 2 other portfolio companies and create a publicly traded master limited partnership. And that's where we essentially achieved not a 5x return multiple on EBITDA on the exit, but a 10x multiple at the initial stages of the IPO. So we doubled the value just by taking that approach. And then over the last 9 to 10 months, it's actually escalated in value from what was an IPO price of $17 per unit to $56 per unit. So that's what gives you the calculation of 1.35 billion, which is where it is today. So terrific success story, and I'll pass it to my colleagues to talk about some of their success stories as well, but happy to take any questions you have at any point.
Thanks, Ted. Does anybody have any questions at this point? Okay, why don't we keep going? We can probably ask some questions of any of our panelists here at the end. We're going to get going here with Howard Morgan, who is co-president of Castle Harlan and has been active in the middle market private equity space for over 25 years. Castle Harlan has raised 8 private equity funds, 5 in the US and 3 in Australia. And with that, Howard, I'll let you take it away.
Thanks. Do we have my presentation up or no? We just go straight to lunch.
It should,
Oh, there, well,
Here
there we
you go.
go. Okay, given the topic of why this was a successful investment, and I'm going to talk to a company called United Malt, it is worth, I think, a couple more highlights as to what we do at Castle Harlan, what we think is a little distinctive about our investment approach. And this is an investment that fit that investment approach really very well on multiple aspects. You know, the general background of the firm you have, but we are a generalist firm that often finds opportunities in niches that are hard to categorize. United Malt, maybe I'll just go to that page, is a leader in the world producing malt for beer and whiskey, a product that hopefully most of you here consume regularly. We bought the business in 2006. I can say indeed that beer and whiskey are counter-cyclical. It appears that in recession people do in fact drink more. And while we didn't know we were going into recession, we did think this would be a defensive niche. We are value investors. We bought this business well. I'll go into some of those metrics. We're also quite contrarian. The issue in this business was whether or not it was a undifferentiated commodity or in fact a very high value food ingredient, which is what it turned out to be. We like doing deals with hair on them. This was a business that was a corporate carve-out. It was very complicated. It was proprietary. It entailed enormous sweat equity on the part of our team. And again, that's one of the aspects of what we look for and what we found here in this opportunity. We are a North American fund, but we're distinguished, I think, by a lot of activity around the world. Danielle mentioned that we have an affiliate in Australia. This was an example where we included the Australian fund as a co-investor. We've actually used co-invest frequently. We think that can add a lot of value to our deals, and you'll see in this case with operations in Australia, it was an important part of the story. We think that in the global arena, oftentimes companies of this size are just too small for the major global private equity firms, and therefore it's a relatively underserviced niche. As I mentioned, United Malt is just a great example of hitting on these criteria. The company had 14 plants in 5 general locations: the United States, in Canada, in England, and in Scotland, servicing beer and whiskey respectively, and in Australia. The business was headquartered in Omaha. It was partially owned by Conagra, which is why it was headquartered there, but it was also 50% owned by a South African company called Tiger Brands. In the case of the UK business, it actually had a third joint venture partner, the brewer Scottish and Newcastle. So it was a complicated business with a complicated ownership that was frankly orphaned, with parents that had different objectives. It was, safe to say, a neglected business. It did not have capital support. It did not have strategic support. The countries were all isolated. It was actually 4 separate joint ventures with 4 separate management teams that didn't talk to one another. Management was not motivated. They weren't owners. The core criteria was a modest annual dividend and instructions not to break the business, which was not a very constructive approach. We learned of this company from a prior executive who had a feeling that it was trapped in a sort of a horrible dilemma with the owners and in perpetual limbo. So we approached Conagra and worked to convince Conagra to sell this business over the course of about 18 months. We ultimately purchased it in 2006. As I mentioned, it was a small business, about $27 million of EBITDA in 4 countries. So average EBITDA of far less than $10 million per country. As a preview, it was a very successful business. Within 3 years, we'd grown EBITDA to $115 million. We paid 5.7 times for the business, so we think a sensible valuation. And we brought in Champ, as I mentioned. In this instance, the transaction was certainly a size that we could have done from our portfolio, from our fund here in the U.S., but given the presence of operations in Australia, our view that the largest growth market was out of Asia and that was going to be most easily served from Australia, we felt there were great growth opportunities, and having a team of our partners in Australia also working on this project made a lot of sense. It helped that we have had a secondment program with our colleagues in Australia. So the partner that started working on this transaction in our New York office transitioned back to Australia relatively seamlessly. And as you'll hear, that was actually a very important element of the success. Turning now to value creation, I think it's important to note that the going-in perception here was that United Malt was not an attractive business, that it was a commodity company, and not a high value-added proposition. Our thesis was extremely different, was that basically this was a critical food ingredient that at pennies on the bottle could have a tremendous impact on the quality of the end product. I would add to that performance during our due diligence was nothing short of frightening. You'll see in the bottom the trailing 12-month EBITDA. We started looking at this business in March of 2005 when EBITDA was 47, and it consistently fell every quarter until we bought the business in 2006. And it was only really through our diligence and conviction that we were able to get over the perception that we might actually be catching a falling knife squarely in the chest. But we were very confident, and as you can see, coming out of our purchase, EBITDA rebounded extremely nicely. Some of this was not necessarily our value add, but making a good investment thesis and energizing management. We'll go into some of the other details of where we clearly added value. But they can be categorized in four broad categories. As I mentioned, our main goal here was to reposition United Malt as a high-quality malt solution. When we bought the business, the product had been sold basically very centralized purchasing departments based on price. What we knew was that the individual plants were run by plant managers, in this case typically known as brewmeisters, who had ultimate say in the buying decisions of their plants. And we knew that if we subtly customized the product, quality controlled it, that malt could have an enormous impact on the output of a brewery. Theoretically, a brewery is nothing but a big specialty chemical plant, and that can be highly influenced by a whole variety of local factors, what's in the local water, what's in the local air, the local ambient temperature, the altitude, all has a significant impact on the performance of any given malt plant. And we started to approach the malt masters or the plant managers to pay more for a value proposition. We also saw a shift towards microbrew, where again, artisanal beers in small plants and frankly big producers like Anheuser-Busch were shifting towards a higher end product that could benefit from a much higher quality product. And we established our credentials in that arena in part by buying a small distributor of microbrewery products, opening up a channel into a new high-value segment of the market. We rationalized the business by combining the four disparate countries. We kept local management, but we had them talk closely and regularly. We created a platform of or a dashboard of weekly metrics that we benchmarked each country and all of our 14 plants against. We bought in the joint venture position of Scottish and Newcastle within the first year, bringing the entire company under one unified ownership. By virtue of having 14 plants in 4 different countries, we also had global access to barley, which was extremely important given the farming and agriculture risk. On a coordinated basis, we could actually offer a supply of barley on a global basis. We diversified our customer base, taking it from 63% with the top 10 customers when we started to only 47% with the top 10 customers. We focused a lot on the top line growth and de-risking revenue. We were able to take market share, but we also switched the buying from spot prices to long-term arrangements where the customer was effectively taking the underlying risk of barley, and we had long-term tolling contracts in their place. When we bought the business, 17% of revenue was under long-term contract. When we exited the business, over 80% was on long-term contract. A critical area, which is consistent across our portfolio, is to focus on investing in the companies. And we invested an enormous amount in both CapEx and a number of small acquisitions. If you have the opportunity in an industrial scenario to generate a 2-year payback, if you run that through an LBO model where you get a multiple on your earnings, the rewards can be just fantastic. In the case of United Malt, we doubled the size of a barley plant in Scotland, and we launched and committed to a brand new greenfield plant producing malt for beer in Australia. In total, we committed more than our original purchase price to the growth of this business. As I mentioned, we also bought in Scottish and Newcastle, but we committed $180 million to grow this business. By 2009, we had grown the company to a forecast EBITDA of $115 million for the year. That was 4 times larger than when we bought the company. We felt that it was a good time to sell operationally, but the facts were that it was 2009, and the markets were horrible. Globally, the markets were basically shut. However, we had our friends in Australia, and the Australian markets were still relatively open. Australia had never gone into recession. The IPO market was still open there, and given the connection, we felt that that was a logical thing to pursue. And we had our partners at Champ, of course, who could help navigate us through that. In a really an element of luck, and I can't say it's much more, in the process of IPOing the business, we surfaced a local Australian strategic, the Grain Corporation of Australia, that was looking to diversify from grain siloing into a grain value-added business, and they stepped up and agreed to buy the business outright.
Howard, I'm sorry, we're getting a little overshot here.
So I'll cut to the chase. The results were nothing short of wonderful. We made 4.8 times our money on this deal. It's worth noting that in the last 2 months of the transaction, we bought in a slug of sub-debt. If you exclude that from our gains, we would have made 6 times capital. Virtually all generated by earnings growth, and again, a good reflection of, I think, the value that we try to bring to global opportunities.
Thank you, Howard. Okay, so just to keep moving, I want to quickly introduce Stephen Thomas from Bain Capital. I don't know how much introduction Bain Capital needs, but Stephen has joined Bain Capital in 2007 from Bain & Company, and Bain has made over 350 investments and has generated industry-leading returns while building a global network. And with that, I want to quickly turn it over. Thank you. Oh, perfect, and you're on.
Thanks, Danielle. I'm going to talk about our investment in Sensata Technologies, which is really a classic and great Bain Capital investment where we partnered with a terrific management team in a complicated global carve-out, and really worked with that management team to develop a strategy to further elevate the operating performance of the business over a number of years. Sensata Technologies today is a public company and a market leader in sensors and controls across a variety of applications spanning transportation, industrial, commercial, and residential applications. To give you a little bit of context on the deal, this was a carve-out from Texas Instruments back in 2006. We invested, it was a total enterprise value of $3 billion, and we invested just under $900 million in the deal at a purchase multiple of roughly 10 times. At the time, the auto exposure in the business was 60 to 70%, and that scared off, I think, a number of buyers, but we saw a really interesting, well-positioned company with a lot of organic megatrends and winds at its back, and it's turned out to be a great thesis. Today, it's a public company with a total enterprise value of greater than $8 billion in the public markets. Sensata, I'll just give you a little bit of description on the company, and then I'll jump right into what we did to help drive the growth. First, it has very high share in the applications it serves. It's in really mission-critical, designed-in applications and things like the engine, transmission, safety systems of a car. Low cost, but in high-value systems and mission-critical. So we saw a business that had incredibly durable positions. And the fundamental business across all these applications is driven by large trends in energy efficiency, fuel economy, and safety that are driving more and more sensor content into the business. Within the context of Texas Instruments, this was not a strategic priority. So our thesis was both to drive significant organic growth and ramp up investment in R&D and new product applications, and also significantly ramp up the M&A efforts. We think the sensors and controls market is pretty fragmented. It's turned out to be the case. We've done a number of add-on acquisitions during the course of our investment that have added tremendous value. I'll just skip here to page 5, and talk a little bit about what we did. I would say, the starting point here is this is a really terrific management team. Tom Rowe and Martha Sullivan built this business within TI over 15 years. We went through the carve-out process and really built a standalone organization, adding key talent and operating processes during that first 6 months. And like we do in all Bain Capital investments, partnered with the management team to develop a strategic blueprint to outline the priorities for the business over the next 5 years. Those priorities really centered around driving more organic growth in areas where we saw significant content increasing in applications. Second, really building the China business. Sensata had gone into China in the late 80s, really from a manufacturing standpoint, but was not focused on serving emerging markets. And so we really accelerated the development of a team on the ground in China, adding over 100 people in China and other emerging markets to serve those locally. And then finally building out an M&A capability within the organization. Since we've owned the business, we've executed over 6 acquisitions there now. All of them have followed a similar formula of either expanding the technology and product scope of the business, but also buying businesses with mid-teens type margins and plugging them into Sensata's high volume, low cost operating platform and driving significant operating synergies. And the combination of those things has driven tremendous value on the content side. There's been penetration across a number of systems. I give an example here of electronic stability control, which has been a powerful driver within the automobile, and you can see the continued penetration there, which has driven a lot more sensor content into automobiles. Sensata is really leveraged to the growing middle class and emerging economies. Really in the early phases of development, they sell a lot of controls into basic motors and household applications, which then migrates into higher value content as they develop. A number of the acquisitions that we did with the Sensata team over time, as I mentioned, sort of in the $50 to $150 million range each. In each of these has been really transformative around both the technology offering and the underlying operating performance. I'll skip over this, but China has become a significant base of production, and overall low-cost country production has been accelerated during our ownership and is now just over 95%. The one challenge we faced in this investment was clearly the global economic crisis. Revenues fell 40% in a year, given the cyclicality of some of the end markets here. Sensata did a just terrific job, and we partnered alongside them to take out a lot of costs during that downturn. And we really emerged from that downturn as a stronger company. It was a great company before with mid-20s margins. Today the margins are just under 30%. And the business continues to operate in a really efficient way and learned how to do things even better through that crisis. So I'll skip over that. I think overall, just to summarize, this really highlights how we can add value in an investment. We are a people-intensive model from the early diligence phase all the way through ownership and value creation. We are very partnership-oriented, and we really work with our management teams in a consensus-based way through facts and persuasion, and that's been incredibly valuable in formulating a lot of consensus around a strategy. We surged into this company during the difficult times, and that really drove a lot of value coming out of the downturn. And fundamentally, we're growth-oriented investors, and that's what we really liked about this investment, both in terms of investing behind some of the mega trends I talked about, but also building a management team and rounding out that team in a way that they could go really develop a global strategy and execute on a global basis. And this is a great example of doing that.